All right, welcome to the Fit Bucks podcast. For watching on YouTube, welcome there as well. Got a special interview today with Kenton from Doc2Doc. It's going to be a fun one. We're talking about some of the tools and products that they are coming out with to help docs from the lending standpoint. Go through a little bit of how the history of how they got there, Kenton's background, all that fun stuff. Before I do, I don't want to steal any of your thunder. Welcome to the show. Glad to have you.
Thanks so much for having me, Joseph. Really a pleasure to be here today and be part of the FitBucks community and podcast.
Yeah. Before we even talk about Doc2Doc, I want to give all the listeners and people watching this on YouTube just an opportunity to get to know about your background. How did you get to where you're at today? What led you into working with Doc2Doc? Just touch a little bit about your background and then we'll go from there.
Sure, I'll give the abridged version here to start with, but my background, I grew up in New Hampshire, went to school in Western Massachusetts for college at Holy Cross, and was considering medicine at the time. Ended up going into medicine at medical school up in Dartmouth, and at that time they were promoting a dual degree MD MBA program, and that kind of caught my eye, and so spent a couple extra years up there in that program, and when that finished, I went to residency, which was in Boston, to train in anesthesiology, and that was the impetus that kind of set the spark for Doc2Doc. When I came out of medical school, I had about $230,000 in student loan debt. I had met my wife, who was a nurse at Dartmouth. We met and got married there, and by the time we moved to Dartmouth, already had our first child, and she was pregnant with our second. My salary as a resident was about $54,000 a year. And my wife had supported us early on while I was in school, and she had some professional goals. She wanted to go back to school and get some more training. And so all that is to say is that during that period of my life, I was working between 80 and 100 hours a week clinically, but the most stressful piece was the financial aspect. My salary wasn't supporting our family, and I was really disheartened and frustrated to find that I was viewed as a high risk borrower, and nobody would touch me. And so be happy to share kind of more about how that went. But to kind of round out my introduction, I went back after all that, subspecialized in anesthesia back at Dartmouth, and now practice out of the Mass General hospital system. I practice a fractional FTE, and the balance of my time has been dedicated to Doc2Doc since 2017. And basically our business premise is that physicians and dentists are more creditworthy than we look on paper, the way that banks typically look at people, and that we as a niche population should be looked at differently. So that's kind of what brings us to today, and part of the reason why we're here.
Yeah, that's the thing that I always get amazed by, is that with banks, like, because I know their lending algorithms, and I get it that banks, I mean, they got to do scale, right? Like they're massive, and they can't employ a bunch of people to do underwriting, like, so they have all these algorithms that do the underwriting for them. And I've always been amazed about how for certain professions, they don't make adjustments to their algorithms. It's like a one size fits all type of thing. It's like, that this is amazing to me. But then at the same time, when you talk to their CEOs of these banks and some of the higher up people in banks, they'll tell you that they need to get doctors and they need to get dentists, because those are the prime people that they want at their bank for their private wealth departments and all that. And I'm like, well, wait a second, you guys have a perfect opportunity to start working with these people, and you're giving it up. So I definitely see the need for it and what you guys are doing, and that's definitely huge. Side question on that: how'd you like living in Boston?
I loved Boston. So Boston, the we lived in Jamaica Plain, if you're familiar with Boston, which when we were there was not a great part of town. Which is, our rent was still over $2,000, and it was not a great part of town. But what I loved about it is that it was a really manageable city, meaning that you could get from point A to point B. It's pretty clustered, so you can get around it pretty easily. They had a ton to do for kids, and we had a really great community. We met still some of my best friends, my wife's best friends down there, and not through our jobs, just kind of being out and about. I think Boston gets a rap for being kind of rough and tumble and not that friendly, but that wasn't our experience there. We had a really nice time.
Yeah, bring up that side note, like my in-laws are from Boston, so they have a place right in like Boston Commons in Chinatown. So we go up there all the time, and my wife was trying to convince me to go up there in July, and it's like, that's a little bit too hot and muggy then. We'll see. But yeah, I definitely enjoyed doing that. Going back even prior to school, how come when you looked at the field, just going into healthcare and whatnot, what really just drove you going into that direction to begin with?
Yeah, initially I liked the sciences. I think that's kind of what sparks it in a lot of people. And for me, I didn't know whether that was going to bring me to benchtop research or clinical kind of direct patient care. I left out. After college, spent a year down in DC at the National Institutes of Health, and was in a division that allowed me to have a foot in both those realms. So I was working at the experimental transplantation and immunology branch, which was really fascinating because they were treating late stage cancer patients who had failed all the available treatments out there, and were in these early clinical trials for promising kind of basically animal studies, technology that had been used in animals but never in humans. And so we would go round on the patients in the morning. You take blood samples, and then we'd spend the afternoon in the lab, running the tests on the blood samples. And so for me, the more rewarding of those two realms was the interaction with the patients, and so ultimately led me to medical school. But it also gave me a huge respect for the research and the impact that can have.
Yeah, yeah. I didn't. I always said for me personally, like if I ever went in the medical field, I'd be 100% like research, like like trying to work on patients and work with patients. I'm a data person. I love looking at research. like
It's
that was
amazing,
my route.
the impact that you can have on a 10,000 foot scale. I mean, is one breakthrough can really has the ability to change the world. So
Yeah.
I can see the appeal, and it's highly data driven.
Yeah. But then also people ask me too, like, because I'm a finance guy, they're like, well, what would you go into the med field? I'm like, anesthesiology. Like, they get paid the most. Like, or one of the most, like, so yeah, it's good stuff. It's good stuff. With Doc2Doc, like you brought up some of the problems that you ran into borrowing. Um, Actually, before we even get into Doc2Doc, dive deeper into that. So that way, some of the viewers that don't know, maybe they're still in school, maybe they're coming out of school. Um, what are some of the issues that you ran into when you were trying to get different types of loans, that it be personal loans, mortgages, student loan refinance, whatever it may be? What were some of the issues that you saw when you're coming out and doing your residency and whatnot?
Yeah. So when I said I was viewed as a high risk borrower, again, my financial profile at that time I shared with you had a significant amount of debt. That was my income. My wife was working part-time. Um, and and although I didn't have any black marks against my credit profile, had never missed any payments on my student loans, or not paid my credit card bills. Um, I had an immature credit score, primarily because I had been accumulating debt for the last 6 years in school, and not building wealth. And so when you compared my credit profile to those of my peers who went into finance or management, or marketing or really anything other than medicine or dentistry, I was about a decade behind building a mature, strong credit profile compared to them. Now, the components that I'm alluding to that made me look high risk, one of the big ones was, it's called debt to income ratio, which is a really kind of universal almost metric that banks use to see if you are going to repay the money that they lend you. And then secondly was my FICO score, which, as I said, didn't have any black marks, but wasn't mature and very strong at the time. And so as what I needed was just money to kind of keep our goals on track, to supplement life. And we had, for my wife to go back to school, for example, we needed to put 2 kids in daycare, and when you added rent and daycare costs together, that pretty much took up my entire salary. And so our position we were in, or are we going to kind of put some of these things on hold, or are we going to borrow money now to keep things on track with the expectation that we'll be able to pay that back later. And in our position, from day one of residency, we had really lucrative job offers for 3 years later. And so it seemed like something was missing. My solution was imperfect. I used credit cards primarily, and I was in my mid-30s at the time, and asked my family for help. And I was fortunate to have a really supportive family, but again, in my mid-30s, it was humbling to have to go and say, I'm in a tough spot financially. Can you help me out? And so that's kind of how we got through that, because like I said, the borrowing options, there were a few people that would even consider me as if there was a personal loan borrower.
Yeah. And just to let people know too, especially if you're listening to this, think about going to med school. This is something that we see a lot that people don't realize going in. They don't think about the residency. They don't think about the fellowship portion, about the how they're going to survive, because they don't realize they can't get a student loan. Like, you're not in school anymore, technically, so you can no longer get a student loan. And so we see it all the time, that situation where it's like, oh crap, what do I do? And that's actually one of the big reasons why we see so much credit card debt with MDs that are going through residencies. I shouldn't say MDs, but people that are going through residencies and fellowships and everything. Is because it's like, where else do I turn to? And the first thing they do is go out and get credit card debt, when in reality, it's like, well, you should actually go out and get a personal loan instead. And the reason why, so those of you, and I don't know if you've ran into this, you might have ran into this at Doc2Doc, is that when you get a personal loan, it shows up as a loan on your credit report. And a loan doesn't hurt your credit score as much as what's called revolving debt. And so a credit card is revolving debt, and that's the way it goes on. So if you're going through your residency and the first thing you do is you get credit card debt, your credit score is going to get hit really hard. And then you might not be able to use any more credit card debt because you hit your limits. You can't get another credit card. So then you're going to go to a personal loan and you're going to get denied because your credit score is too low. So typically the process is go and get your personal loan first and try to get as much as that, because it's also lower interest rate than credit cards. And then if you can't take it out any more personal loans and you still have some stuff left over, then go to the credit cards if you really need those as a last resort. And we see people make that mistake all the time, not just with MDs, but just in general, graduating. They start using their credit card. Then they go out, they want to get like an auto loan, or they need to refinance their student loans or something like that. And their credit score is just like destroyed. And it's like, yeah, like you went the wrong way. So those are some of the small things that we see, that it's like, you make those little tweaks, not only does it help you today, but in the future, it's going to end up being tens of thousands, if not hundreds of thousands of dollars, if you just make those small little tweaks. So
Yeah.
not sure if you guys have run across that very much at all.
We do, and you articulated it really well. So one of the major determinants of FICO score, as you said, is the credit utilization, meaning
Yep.
that if you have three credit cards for $10,000 each, your total credit available to you is $30,000. And the percent of that $30,000 that you're using at the time your credit is pulled is a huge component of um, of uh, of determining your FICO score. So in residency, oftentimes you're often offered credit cards of $5,000, and if you're using $4,000 of those, well, it's 80% credit utilization, which is considered a very negative number. And then the second component you alluded to is the installment and revolving that is called credit mix. So having a profile that shows on-time payments for both types of revolving and installment credit is a way to really boost your credit score. And so the way that we've seen it, Joseph, is for people who know that in their future they have a significant purchase. So, for example, a mortgage. So people who are towards the end of residency or coming out of residency know that they want to buy a home when they get their first job, and they want to make sure that their credit profile is as strong as possible going into that large purchase, knowing that for it's going to be something that they pay over 15 or 20 years, and 1 or 2 percentage points in that mortgage can be the difference of even tens of thousands of dollars. And so the credit card debt that they've accumulated, they will pay off with a personal loan through us to Doc2Doc. There's kind of two benefits to that. One is it brings your credit utilization essentially to zero. The other is it shows that you have both revolving and installment debt. Three is the interest rate's lower, and four, there's a path to paying it all off and ultimately not having credit card debt. And as opposed to the credit cards, which generally try to keep that debt on the books. So we work with a lot of people who are in that position and looking to shore up their credit profile. Oftentimes, in the setting of knowing that they're going to have a major purchase, like a mortgage, or starting a practice and needing a practice loan, or buying into a practice and needing capital to purchase equity in that practice.
Yeah, yeah, no, that's definitely. I mean, those of you that don't know, and I'll put a link to this too about the credit utilization ratio in the show notes. Like, it's massive. I mean, when we back solve, like I'm that dork that looks at a lot of data and on like financial stuff and companies that try to back solve into the credit bureau's algorithms. Like, and every research shows that credit utilization ratio, it's like 25-35% of your credit score. It's one of the biggest things that goes into it. And like you brought up how to manipulate it, like the personal loan, so that way you get lower credit utilization ratio to go out and get a mortgage and stuff, and it helps your credit score. Like, we go one step further. Like, if you're going to be going down that route, like when I was in college and I figured this stuff out, like about that utilization ratio, I knew I wasn't going to be buying anything for like 5 or 6 years. So every quarter I'd open up a new credit card and just start, because every time you open up a new one, let's just say you open up a $5,000 credit limit, another one that's 5,000, another one that's 5,000. Next thing you know, you got 10 credit cards. So your overall credit rate, like utilization that you can actually use, is 50 grand. So if you have like 2 grand outstanding on it, it doesn't hurt you. And so that's how we manipulate it. Like, if you're in undergrad or you're in school and you got another year or two to graduate, it's like open up a couple of the credit cards, try to get that number up higher, so that way that ratio is really, really good. Because once you like take out about 10 to 20% of that ratio, so let's just say you have $10,000 available to you and you take out like $1,000 or $2,000, it starts hitting your credit score a lot. Like, people don't realize it. And if it keeps going up higher and higher and higher, like you got 50%, it really starts destroying your credit score. And so yeah, the higher that credit limit is, better. So now, like, my wife always gets mad at me because, like, I think I have like 10 credit cards open, something like a $500,000 credit limit, and I only use like 1 or 2 of them on a regular basis. But you have to keep them open, and a lot of companies, they make you spend, like, if you don't spend money, they close it. So like I'll take one out like once every 2 months and put like $5 on it.
Sure. Sure. Well, yeah, that's a great thought. That's manipulating the denominator and not just the numerator.
Absolutely.
We work primarily with the numerator. But the other great point you raised was keeping the credit cards open. I made this mistake coming out of residency, thinking that I was being really responsible, and I closed one of my credit cards that I
Mhm.
had for 5 years, and learned the hard way that one of the other things that is in that FICO score is credit history. But as soon as you close it, you lose the history of those positive payments. It has to be active, and so by closing a 5-year-old credit card, my credit history went from 5 years to the new one I opened, which was about 6 months old. And
Yeah.
again, a tough lesson to learn
Yeah.
the hard
It's
way.
why like a lot of those internet bloggers that are like, we're gonna be a financial coach. Close your credit cards. It's like, no,
Right.
don't do that. Like, yeah, me and Citibank don't have a good relationship because they try to close one of my credit cards, and yeah, it had like a $30,000 credit limit on it, and I was like, no, like stop, I'll use it. Like, I get your message. Like, um, yeah. So, newsflash: if you have credit cards, don't close them. Like, just be responsible with them. But there's another business line for you guys down the future: Doc2Doc credit card. There you go.
Yeah. We have them actually. They're business cards. They're primarily aimed at practice owners.
There you go.
Yeah, yeah,
Yeah, start trying to market it. And I shouldn't say new product. I say new target market. I'll start saying to people like in their early residencies or in school, here you go. Like, here's a strategy for you.
yeah. The what we found is we've now worked with about 5,000 doctors, uh, and every time someone applies for a personal loan through us, they speak with one of our doctor team members. So they speak with a doctor,
Mhm.
um, and I think through that there's been a lot of trust built, and so people are coming back to us for what their next need is, and so we're trying to meet that. One of them was kind of again credit cards tailored to medical dental practices, which is how that kind of came to be.
Yeah.
The other really common one is I mentioned earlier, purchasing shares in a practice or surgery centers. So we help folks with those
Yeah.
transactions too.
Yeah. Well, I mean, on that note, I mean, some of the Doc2Doc stuff, I've mentioned the name a bunch of times. We talked about it a little bit. Um, let's go through some of the programs that you guys have and talk about, here's the specific loan programs. Here's like the problems. So not necessarily so much like the details of the programs, each one of them, but
Yeah,
like this is what we saw going on in the market. This is what the problem was. This is what it helped, so people know more in depth. Because there's some different things on here, like you guys stuff like with Match Day and practice, like they're not
yeah,
just straight out personal loans. Like,
sure.
oh, I went to XYZ company on Nerd Wallet and try to get a personal loan. Like, these are very specific. So I'll let you start going through them all, and touch on some of them, and then yeah, go from there.
Sure. Yeah. Well, our main product is a personal loan. The benefit of the personal loan being that you can use it for really any purpose. And we we kind of segment our market based on the typical career arc in a career in medicine or dentistry. And the first group being the fourth year medical students, and that's where we do a lot of outreach around match day because student loans aren't eligible for transition costs. And so we have spoke with someone recently moving from Philadelphia to San Francisco to as the finish medical school and go to start residency. And so they have a cross country move with their family, moving to one of probably one of the best residency programs, but happens to be in probably one of the highest cost of living areas in the world. And to get just a place to live with a first, last, security deposit, it's about $10,000. Factor in the moving costs, it's going to be about $15,000. And again, you can't use student loans for this purpose. So we do a lot of transition costs. We help with credit card debt that's been accumulated through medical school with that market. We have a kind of even a branch of off that where we have a program for visa holders, and this is a very underserved population within the medical and dental community. And I mentioned my experience about having difficulty having access to capital. Well, it's even more difficult for people in that position who happen to be foreign medical graduates and are here on visas. And so we have a H-1B, J-1 and O-1 visa programs that we lend to the medical and dental community. Further out into the career, I mentioned during residency, there's kind of a varied uses there, and some of the more common being credit card consolidation, supporting life, be it marriage, children. We've kind of fallen into helping some female subspecialties in infertility and surrogacy for people who want to kind of build their family but not put a big pause on their career in order to do that. And that can be $50,000 just to kind of get things going. And then kind of after the training years, and kind of fully into practice, that's the most varied subset of the medical and dental community that we work with. Some of the more kind of exciting reasons that we work with folks in that time are entrepreneurial activities. And it seems like, over the past 3 years in particular, there's been a real surge in medical and dental professionals who want to also have kind of an entrepreneurial aspect to their professional life, and getting the funding to get their ideas off the ground can be challenging. And so we support folks through that, not just through kind of seed funding, but in kind of more mature ideas who, for example, need an SBA loan, but you have to put 10% of your own capital into an SBA program. And so supplementing those applications to the SBA program. And then just, major life events, health scares, marriages, divorces, things that come up for reasons that you need some extra dollars for that period. We've made the process really what we believe is to be friendly. So the product in those early years, we offer interest only payments so that it's not a cash flow struggle by paying interest, and again, that's an option that's available to folks in the early years. We have no prepayment penalties. We encourage people to get out of debt. As you compare a personal loan interest rate to a mortgage or car loan, the personal loan is going to be a higher rate just because there's no asset to securitize and back that loan. And so we encourage people to pay off our loans when they're able to. And there's no prepayment penalties on any of our products to support that. And then the last thing I'll say is that we make the process really easy. It's about three page on a computer screen or your phone, and you get immediate terms sent to you. And then, like I said, you get an offer to speak with one of us, and that happens within the 12 hours of the application. And then the funds, if accepted, are generally in your bank account within 5 to 7 business days. So try to make it an easy process with some friendly terms.
Yeah, I might have to FitBucks is focusing on medical. Like, we need some seed funding. No, it's fine. So you brought up earlier too about like the buying into a practice. For those of you that are out there that have just thought about that idea, can you talk about that process a little bit and how like your guys' loan product can potentially work around that to help people buy into practices and whatnot? Because I know a lot
Yeah,
of people that they have that idea, but they're not familiar with the whole process of what goes into it.
yeah. So the you know the product that we've designed is meant to be an alternative for a very common way to become a partner or an equity member of a practice. And currently, for a lot of folks, what will happen is you join a practice and you'll as a non-partner, a non-equity member, and for a period of anywhere between 2 and 5 years, work at a deferred compensation, meaning that your salary is less than the equity holding partners. But after a period of time, that 2 to 5 year window, then you're granted equity in a partner, meaning that if the business makes money, then as an equity member, you get a bonus payment in addition to your salary. And the thought is that over that period of time where you're making less money in your salary, the difference between what you make and the partners make is used to purchase that equity. Now, the downside to that model is that if you think about when you join a practice, well, you're bringing value to that practice. You're going to bring more patients. The value of the entire practice is going to benefit from it and grow. However, the you don't necessarily realize the benefit of your own value because you don't have equity in the practice until that 2 to 5 year window. And the alternative is to purchase the equity at day zero. And that's what we offer the option to do, to say, I'm going to join this practice. I'm going to buy in now at the value of the practice on day zero. And Doc2Doc is gonna help us pay for that. But now, what you own, that share, if you kind of think of it as a stock, that stock that you hold in the practice over the course of 2 to 5 years is going to become more valuable just because you're there. And so you can kind of benefit from your own impact. And so it's a from the perspective of the physician or dentist joining that practice, it's a better alternative in a lot of ways. And so that was a common story that we were hearing, that people were bringing back to us saying, could you help me kind of find funding for this purpose? And it's really difficult to find because you have to know how to get an accurate valuation of a practice, know that you're paying a fair price. It's a little more nuanced than a lot of the products out there. So we've kind of taken the time to do that and become pretty facile with it so that we can offer it to folks. And so that's kind of how we work with folks in that realm.
Yeah, I'm a former valuation analyst, so if you guys need any algorithms, let me know.
Excellent.
Actually, for the listeners that don't know this, that's one of the things that we actually do at FitBooks. Like, that's different than a lot of financial companies. So, like, Kenton, you brought up how a lot of traditional algorithms at banks for loans, they just look at your current stuff, your DTI or anything like that. They don't take into account like your future income, the risk of that income, anything like that. That's why you can't qualify for loans. But it's not just lending, it's the entire financial services market does everything like that, for asset management, for how you repay student loans. Everybody, that's all they do, is they just look at the now. And so in the world of finance, we have what we call human capital analytics, which basically projects out someone's income, but the risk to that income, and we can value that asset and how much it's worth. And for MDs, it's a lot. So that's why it's like, algorithms can tell you, no, you're not in a bad situation. You're in a really good situation. And it's similar like what you guys are doing with underwriting for loans, but for everything. And so, like, when you're talking about that, yeah, I see it all the time, because people are just like, yeah, like, I mean, MD, like, why can't I get these things? Like, it just doesn't make any sense. It's like, yeah, you're right. So, hey, like you said, good luck trying to buy into a practice just coming out of school. You have no money, like.
Yeah.
So yeah, I see the definite need there. It's awesome that you guys are doing all that. Closing words. Any last thing that you want to touch on? let everybody know, first and foremost, let everybody know how they can get, to you guys at Doc2Doc. Anybody, anything last words that you want to touch on?
Yeah, I just thanks for again letting me be part of the FitBucks community here today. We're we're trying to smooth the road that we walked for the folks following behind us, and so to the extent that that we can be helpful at Doc2Doc, that I can be helpful personally, if it's through one of our products or just a conversation. Like I said, we have a panel of really great, both physicians and dentists who uh, who who love to see where we can be helpful. And for our loan program, it's right at our website. Again, the application page is right there. Um, doc the number 2 doclending.com, and Joseph, if anyone reaches out to you, be happy to speak with them if you want to put them in touch directly. So again, thanks for letting me be part of things here. It's really impressive what you're doing with FitBucks and with the community that you built. And again, humbled to be part of it today.
Yeah, and thanks for coming on. And one closing piece that I'll say that I really like about Doc2Doc is that when you call them, you're actually talking to like doctors and dentists that have been there, like they're actually going through it. Whereas if you call like a typical personal loan lender, like Lending Club or something like that, it's like, yeah, like we're some person that doesn't really know anything about finance. We just have a computer in front of us that tells us what to say and spit out some numbers. Like they don't really know anything about what you're actually doing. So I think it's awesome what you guys are doing. Thanks again for coming on. Go visit them. If you're, a doctor or a dentist, you need that, any type of a loan, go to Doc2Doc. If you guys need help, as always, with anything with your financial plan, fitbucks.com, sign up, build out the entire plan, and go from there. I will talk to all you guys soon. Thank you.